Joining us now from Paris is Alain Bokobza, Global Head of Asset Allocation at Societe Generale. Good to see you there in Paris. Can I just ask you, when you get this constant drip of information, today it's Greece again, it's also Ireland, how does that affect what you do when you start work in the morning?
I think there is not really new news coming from either Ireland or Greece. What we have is continuation of austerity programs and a huge pressure on these countries to continue to restructure in terms of competitivity. It's not a black swan event anymore. Everybody is aware that these countries need support from the European authorities and the IMF.
We had those very positive sounds from the G8 and also the OECD last week saying that growth is continuing, it's self-sustaining. So are equities the key for you? What are you favouring? What are you avoiding?
I think globally we have been living in Q1 what I would call a liquidity-driven markets. In the end, one made money on bonds, one made money on equities, on credit, and even if it was an inverted V shape, also on commodities. I continue to believe that with the slowdown which has already occurred in the major three economies, US, China and Japan, there needs to be laxist monetary policies in order to support growth for the rest of the year. This is good somewhat for risky assets.
There has been increased interest, demand for the relative safety of government bonds. What do you think about US Treasuries?
That is one of the most dangerous assets around. US Treasuries were supposed to be a very bad asset ahead of the end of QE2. It has been an outstanding performer in Q1. But now reaching a level close to 3% for the 10-year US Treasury, I think this is the end of the bull process. We should switch and play really the end of Fed buying and switch into other assets.
Such as?
Such as, I would say that if the Fed maintains a zero rate and long bonds remain very low and have capability to turn around, I would switch into equities. As they have good earnings momentum, especially in developed countries. There is M&A coming, and this is an incentive to switch out of the corporate bond into the equity market. And there is also huge cash which allow corporations to invest and to distribute into dividends. So I like very much the equity market at this point of time.
What about the dollar? Is that just looking weaker in the long term as far as you can see? And how does it compare with the euro?
No way one can argue in favor of the US dollar, considering the structural weaknesses of the US dollar and the US economy. Nevertheless, the euro is already hugely expensive against the US dollar, somewhere in the region of 2 standard deviations away from long-term norm. So my game would be to say that maintain a short exposure to the US dollar, but mainly against Asian currency, in which we're expecting a regime shift and more quicker appreciation of this currency against the US.
And Alain Bokobza, I'm really grateful to you. Thank you very much for joining us here on the Move.